What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your co-host, Thomas Kopelman, here with me, Jacob Turner, and today we're going to talk about maximizing the qualified business income deduction at the end of the year. So for all of you that have been following, thanks for making it through the insurance series. I know insurances are probably not the most fun thing to listen to, and 5 or 6 weeks of it is a lot, but I think part of the job as a financial advisor is to talk about the things that you don't want to talk about or you don't think about, right? And I think, Jacob, probably you and I can both attest to this. Like, people have no problem spending time thinking about saving taxes and investing. They have a really hard time thinking about all the other parts of estate planning and insurances and risk management and, liability protection, all of those things. And so, we have to talk about them. We have to help people on it. And we actually probably have to talk about it more because it's harder to actually push people to go get those things done.
Well, yeah. And I think, even with what we're going to talk about today on the tax planning side, I think it flows really well from the insurance conversation, because if you think about every conversation that people have with a quote unquote financial advisor, a lot of times, like, their first thought is like investments. Investments can be really fun to think about, whether that's an investment you're making in your business, whether that's an investment you're making in the public markets. But I think so oftentimes what I'm seeing time and time again, I know you're seeing this too in your practice, is a lot of the things that we're helping clients with are those things of just helping them get something to the finish line. So whether it's explaining a tax planning concept, but then also getting it to the finish line, whether it's explaining an insurance concept like we talked about, but also getting it to the finish line, the things that you might not see, but they really can affect your bottom line. And especially on the insurance side, a lot of times we don't think about that until oftentimes it's too late. And then you're flipping through your documents like with one eye closed, hoping that it's right.
Yeah. I mean, totally. And so that's why we had to go through that series. And now, for the rest of the year, we have a lot of good topics for you. But today's one is really around the qualified business income deduction, or QBID. You'll probably see people talk about it. So I think the best place to start this conversation is understanding what it is, who it applies to, and why you have to plan around it. So basically, qualified business income deduction is for business owners. So if you have a pass-through entity, which just means not a C Corp, then you get the qualified business income deduction. This is a relatively newer thing, and it is set to expire in 2026. Basically, what happened is corporate tax rates went down. QBID was created basically to help make sure that people weren't paying significantly higher tax with these pass-through entities. So, if you're an LLC, tax as a sole prop, partnership, or if you're an S Corp, you have this deduction. And this is something I feel like most people don't understand or know about. They think tax planning is, okay, I'm a business, I need to become an S Corp, I need to pay myself 50% through salary, 50% through distributions, and I'm going to save on self-employment taxes, and that is great tax planning. But what people fail to realize is the qualified business income deduction is part of that. And so I'm going to share this graphic that I've made to kind of just walk through really what it is. And so if you're listening, I've written about this. It's on social media all over the place. I'll put a link in there. And for those of you who are watching through YouTube, this will be easy to see. But can you see this? Or, yeah, you can see this. Perfect.
Yeah,
right?
We're good.
Okay. Perfect. So I'm only going to really explain one side of this. We'll just go with married because that's typically what ends up happening. But the qualified business income deduction is really simple for the first very long time. So any business, if you have under $383,900 of taxable income, and that's all income, not just this business, then you get this deduction and you get 20% of business profits. So if you have $200,000 of profit, you get a $40,000 deduction, which is obviously really impactful. Going back to that example I just talked about with the S Corp, the reason why it's not that simple is, let's say you had $200,000 of profit. You're told, hey, great, go become an S Corp. Now you have $100,000 in wages, and then you have $100,000 in profit, right? You did save on self-employment taxes there because not all $200,000 is really you have to pay self-employment taxes on. But because profit went from 200 to 100, your deduction went from 40,000 to 20,000. Anything I missed there, Jacob, you think we should add?
No, the only other thing I would add, just as like additional context for people to understand, is I think a lot of times business owners, even when I brought this to their attention, they're like, well, this isn't something I've heard of before, or my CPA has never brought this to my attention before. And I think there's two things to think about. One, oftentimes the CPA that we've been working with the situation, maybe they have been doing it, but maybe they never explained it to the client. And the other thing to think about is you might actually not be doing this the right way. And it's just because of, to your point, Thomas, this was part of the 2017 tax cuts that Trump put into place. So this is a newer concept. It went into effect in 2018. And if you've been working with the same financial team the entire time and they're not being proactive about what those tax law changes look like, there's a chance they haven't been fully taking advantage of this. So I think this is a really helpful graph for people to see, okay, what does this actually mean, to make sure that they know what questions they can be asking their financial team to make sure they're doing it the right way.
Yeah, and I think there's a lot of great points there. And what I find is that because most people engage with their CPA in about February, there isn't much you can do at that time. Pretty much all tax planning is done besides things that you can do to reduce profit of the business, right? So you can do profit share into your solo 401k or regular. You can still contribute to cash balance plan, but pretty much everything else is gone. So if anything, if you're under this income limit, all you're going to do is reduce profit and reduce that deduction even more. But things then start to get interesting. So from 383.9 to 483.9, there's kind of this partial phase out. And so we're not going to go into too much detail there. Just know in that gap, you have a phase out. And then when you get to greater than 483,900, it gets even more interesting. So you at first have to look and say, am I a specified service, trade, or business? Basically, an SSTB is a financial advisor, a lawyer, a doctor, a consultant. Pretty much anybody that is hired because of their name, image, likeness is no longer going to qualify for the qualified business income deduction. So hey, if I make more than 483.9 and I'm any one of those, and you can go look this up online and it'll have a list, then you'll know you get no deduction. Really easy way to figure this out is go to your prior tax returns and you'll see if you're QBID eligible on there and if you got any of the qualified business income deduction. So we're here, right? 483.9, and let's say we figured out you're not SSTB, so you still get the deduction. So the deduction is different. It's no longer the 20% deduction. It's the lesser of 20% of profits or 50% of W-2 wages. So let's use an example. Let's say you have $1 million of profit, you have 200,000 of wages. Okay, well, $1 million of profit, 20% of that is a $200,000 deduction, and then 200,000 of wages, 50% of that is a $100,000 deduction. You don't get to pick. You have to take that lesser amount. So you get the $100,000 deduction, and basically there's this $100,000 of room here that you missed out on this deduction. So I'm going to pause there because I just talked a lot. And I'm going to unshare. Jacob, anything that you would add to that part?
No, I think it's a great primer. And I think, to your point, this is where I think people get lost in the weeds a little bit, is they understand an initial concept, but then they don't understand what it actually means for them to take it to fruition. So let's think about any business owner. Let's think about us in our scenario, right? We started as a partnership. We moved to an S Corp as the company got bigger. But if I would have just read about that online, I would have said, oh, well, we're making X amount in profit. Like, we should just immediately move to an S Corp. And then I wouldn't have understood, like, what are the other things I should be thinking about? Obviously, in our situation, we're in SSTB. But what I see a lot of times is somebody says, well, I'm making a bunch in profit, and I heard about this QBI thing from Thomas and Jacob. Like, I should be doing that. And you need to understand, like, how do all these things come into place for you in your situation? And I think what we're going to spend the majority of our time focused on today in the conversation is those business owners that are making significant profit, that had the decision point between, okay, do I need to take 20% of the QBI, or do I need to maximize the wage income and get 50% deduction from that standpoint?
Yeah. Yep, totally. And so on this higher income side of things, there is a lot of planning to do around it, right? One example right here is, okay, let's say, I've had some people come work with me, 2 owners, partnership, they make a ton of money. They get a $0 deduction, right? If you have no wages, you don't get a deduction. And this is where the S Corp can be more beneficial, right? I just talked in the beginning about if you have an S Corp, lower taxable income, you're actually giving up some of the qualified business income deduction because you add wages and reduce profit. On the flip side, when you get to this level, very high profit, if you don't have any wages, you basically get no deduction. And so that's where a lot of times it makes sense. Great. Okay. I had $1 million in profit. Let's elect S Corp. Let's pay myself this salary. Great. Now I pay myself $250,000. Okay. Well, now I have $750,000 of profit. And now you're getting pretty close to optimizing this deduction. So let's go into a couple examples, because I think that's kind of the area where it becomes the most helpful. And I think one thing that I want to hit on here is that sometimes you can't maximize this. You just can't, right? I have some businesses that I work with that are very wage heavy, right? Maybe they do 10 million in revenue and maybe wages are $3 million because they just have to have a lot of employees working and helping. At the end of the day, there's not much that you can do, right? If you have like a $500,000 profit and $3 million in wages, just know that you're only going to be able to take the profit side. The way that you can help on this, right, is potentially when you at the end of the year, instead of paying salaries, you could potentially pay them through profit sharing, right? So maybe that doesn't increase salaries, but it does decrease profit. Sometimes that's going to be helpful for you. It's, hey, I want to keep my wages as low as I possibly can while still hitting that reasonability standard, right? If you pay yourself way more through a bonus and you didn't need to, again, you're reducing profit and increasing wages. And at the end of the day, you're going to end up lowering what you get from the qualified business income deduction. Anything you want to add to that?
No, I think it all starts with understanding your business in general. And I think the way that I like to think about it first and foremost is you need to educate the business owner on the fact that, like, yes, you might be paying more in self-employment taxes, you might be paying more in payroll taxes, but at the end of the day, the QBI deduction is going to be a lot bigger. Because I think that's what we always hear, right? You elect S Corp because now you're going to avoid some of the payroll taxes on the distributions. And like that can be a great strategy. But when you look at the difference between doing that and paying yourself essentially the lowest reasonable salary you can versus planning and actually doing QBI the right way, there's a really big gap there. And I think, the other thing I would just tell people is a lot of times what we're doing on planning, I know we're going to talk about a couple of examples here, is you can run a special payroll at the end of the year to get your payroll, to get your wages to where you want them to be. But again, that takes planning on the upfront to know going into the year, like, hey, maybe I'm going to keep more money in the business to be able to run a special payroll at the end of the year.
That's a great point. And that's actually what we do with almost every single client. So you do have to have cash, right? So you need to make sure throughout the year you're saving for this, or at the end of the year you're saving for this. But that's pretty typical, right? So at the end of the year you say, hey, we don't know where we're going to end up. We're going to take a guess. We're going to guess throughout the year, the beginning of the year, the middle of the year, and then we're going to keep tracking with it. At the end of the year, we're going to realize, okay, wait, we're profit heavy. We need to run a bonus. And on top of that, when we run that bonus, we can max out your solo 401k or your 401k. And on top of that, we can withhold all the taxes we need to avoid penalties. I would say this is like one of the most common things for especially high income. If you're low income, right, you kind of have to be paying yourself the salary. But for people who are very high income, high profit, they'll just pay themselves through distributions and run that one large payroll in December. And when you withhold at the end of the year, it can help bridge the gap of what your shortfall was on safe harbor. So everybody hears you got to pay quarterly taxes to avoid safe harbor penalties. That's true. Or you can do it through withholding. And when it comes through withholding, it doesn't matter. So if you're 50K short, 100K short, and you have to run a $300,000 bonus anyways, withhold all of it, move on, and you don't have to worry about safe harbor and having any penalties on underpayment.
That's a really good point. I think that's something that, again, it goes back to like all the puzzle pieces have to fit together. And this is why you need to make sure that if you don't have somebody that's doing proactive tax planning for you, you need to have a conversation around adding somebody that's going to do proactive tax planning. And I think this also goes into account to make sure that the person that's doing the proactive tax planning, if they're not the one filing your return, that they're communicating this with the CPA. Because if the CPA is not aware that you're doing this proactive tax planning, in our case, Thomas and I are doing that for clients, then they're sitting there saying, well, wait a second, like we got to be thinking about safe harbor. But on the flip side of that, like Thomas said, if it's coming from payroll withholding in the first place, we don't have to worry as much about safe harbor because we've probably already done those calculations to say, hey, we know we're going to be in a good spot. But again, that goes back to making sure that you have enough cash in the business to be able to do some sort of special payroll at the end of the year.
Yep, exactly. And I think on the qualified business income deduction, I think sometimes people don't realize how impactful it really can be. We have a client this year who last year we expected no profit because they really changed the business. The end of the year, they killed it. This year, they're a very seasonal business. Typically they are at a loss for 10 months and then they have a huge huge profit in the last 2 quarters. This year, they're going to be up the whole year. They're going to do 4 million in profit with 2 employees and the owner, right? 4 million profit. And he's been paying himself, about 175. The other people make about 100. So if you just think about that 4 million profit on 375,000, you're giving up so much of the qualified business income deduction. And so if he didn't have somebody proactive doing this planning and thinking about it, he would have left a lot on the table just for him to, we're maxing out 401ks. We're running a massive bonus to him. The bonus is going to have to be almost $1 million by the end of the year. I talked about the profit share in the 401k. He's maxing his out in potentially a cash balance plan. But even just on qualified business income deduction, he's going to save over $200,000 on taxes this year alone. In California, 37% bracket, 13.3 there. I mean, if you get an extra $400,000 deduction, that's $200,000 of tax savings in this year. So I think, there's probably not too much more that we need to hit on here other than you have to look at this at the end of the year. You have to figure out where wages at, where are profits at, especially because, obviously there's not a lot of planning to do if you're on that low profit side, right? Low profit side is, hey, if you're under that income level, try to pay the least amount in salary and try to maximize profit. A lot of times people are spending everything they can at year end to get the deduction, but you're also losing another deduction over here by doing that. And then when you get above this 483 number, that's where it really gets interesting, right? Let's move out. You're not an SSTB because planning goes away if there is. If you are an SSTB, if you're not, then at year end, you really do need to look at this, right? Where are we at a profit? Where are we at on salaries? Do we want to pay out bonuses through our 401k? Do we want to pay them out cash flow? Do we need to increase your own and use that to fine tune and maximize this deduction? But understand you have to do it in this calendar year and you have to do it early enough in December where that payroll can happen. It's not like a December 31st. That payroll won't end up fully going through. It's kind of like, I like to do it mid-December and know that it's never going to be exactly to the dollar perfect because of a few things, but get it as close as you can.
Yeah, and I think one thing to think about just from in really simple terms, all the concepts that we've talked about today, if you're a business owner out there and you're thinking, man, they've talked about a lot of concepts like how do I actually try to apply this if I don't have somebody that's doing proactive tax planning? The thing I like to start with is the 2/7 rule. So I'm going to give you guys a quick scenario of what I mean by the 2/7 rule. Essentially, 2/7 is taking whatever our business income is and figuring out whatever that is, 2 divided by 7 gives us our salary. Okay, so a quick example, if we had $800,000 of business income and we started at a $90,000 salary, that would leave us business income of $710. Okay, so 800 minus the 90 leaves us $710. Our 50% QBI deduction on wages would be only $45,000. All right, if we do the same thing, but we do a 2/7 rule, same $800,000 business income, but 2/7 of that is $228,000. All right, so our net business income is now $571. Our QBI deduction of 50% of W-2 wages is now $114,000. So the tax savings on that in the top tax bracket is about $42,000. So a really easy way to start is just using the 2/7 rule. Because again, what you're trying to do is you're trying to get really close between the 20% of the QBI and the 50% of W-2 wages. And like Thomas said, you're never going to get it down to the perfect amount. But the reality is if you can get it very close, you're going to save yourself a lot of money in taxes. You're going to appreciate you did it next April.
Totally. And I think the only last thing to hit on here is that rule works really well, but know that you have to have this reasonable salary. If you pay yourself 70 and you have, or 90 and you have 710 profit, you're probably going to get in trouble with the IRS if you get audited. They're going to say you run a business that has 800,000 earnings between you and the business. You're not going to replace yourself for $90,000. And so that's one thing I see all the time, especially in those lower wage ones, is people say, well, why wouldn't I pay myself 30,000 and, and have 250,000 in profit? It's like, you have to pay yourself what is reasonable. I think it's fair at the end of the year to run bonuses and make it higher, but people do forget that because every time you bring up self-employment taxes, people say pay yourself the least. If you bring up this maximizing profits, they do that as well. And so it's a really good starting point, really good use case, and it's a good way to do it yourself, but just make sure you are hitting that reasonability standard because the IRS doesn't like it when you don't. And if you get audited, you're going to pay all the self-employment taxes and you're going to pay excess penalties and interest for missing out on that. Okay, well, cool. I think that's everything that we wanted to hit on today. Everybody, we appreciate you listening. Next week, we're going to go into a lot of different end of year tax planning moves. So make sure you tune in for that. And I think we're getting close to like 60 some 5-star reviews. So please, we have like 800 some people who subscribe and follow this just on Spotify. Leave us a review. It means a lot. And we'll see you back next week.